It's no surprise that tech valuations have taken a hit in recent months, but not all stocks have been painted with the same brush, which is, of course, often the case. So which names have held up and which could be a little more vulnerable here? Bob Pisani has the numbers. Bob?
Hi, Courtney. Despite a modest bounce back in technology prices this year, the big story has been the valuation reset. Forward earnings multiples on even the largest, most profitable tech names are, for the most part, substantially lower than they were in January, in some cases much lower, but there's a couple exceptions. Tech valuations increased substantially during COVID, in some cases reaching historic highs, so some reset was to be expected. Microsoft, for example, has seen its multiple increase for many years, but not this year. It was as high as 36 times forward earnings in January, was at 33 in April, now at 27. Other software names have also seen lower valuations. ServiceNow, for example, often traded for over 100 times forward earnings in the last 6 years, including early January of this year, but it was down to 74 in April, and it's at 63 today. Alphabet has also seen a valuation reset, trading at 24 times forward earnings in April, and now it's at 22. But Alphabet had a huge run-up in its valuation during the pandemic at one time, trading for a 36 multiple. That was an historic high. It's much lower now. Some big names have seen a valuation reset that is even more notable. Meta Platforms, for example, historically traded for an average of about 25 times forward earnings for many years before collapsing this year. Now, one exception to the valuation reset has been Apple, which was still trading at a fairly pricey 28 times forward estimates in April. And though it dropped back to 22 in June, it's since bounced back. It's 28 again. The same with Nvidia, which had a huge valuation run-up in the last few years. It was trading at a pricey 48 times forward earnings in April. It dropped to 27 in June, and it's back at 50 times today. Back to you, Courtney.
Thank you very much, Bob. Well, Dan, a couple comments after hours from some other tech names catching your eye. Dell and Workday. What's going on?
Yeah, I mean, there's two that are kind of competing here, and I think it's important to understand that, Dell, primarily a hardware company, they're talking about seeing, just some cautious buying behavior, which kind of reminds us a little bit of what we heard last night from Salesforce. We talked about it a little bit, a little measured buying activity. I mean, you want to pay attention to companies like this. Dell is a company that does $100 billion in sales. They are a great barometer on enterprise demand. Same thing for Salesforce. Last night, $30 billion in sales. So those sorts of cautionary comments are important. The flip side of that is a company like Workday, it was actually had some positive things to say, but it's really important. We spent some time talking about Snowflake. Snowflake is a company that does $2.5 billion in sales. That net dollar retention number, that is one of the key metrics that investors in SaaS companies look at, was off the charts, 171%. That thing trades at like 30 times sales, okay, 30 times sales. Bob was just talking about 27 times for Apple and Microsoft as being very expensive. So again, I think until we see a materially reset in a lot of these valuations, even like in Adobe, they're going to report in a couple weeks. These are really important to keep an eye on, not just the valuations and where they might trough, but also the direction in which the guidance is telling you where enterprise spending is going, because that is going to be the determinant of these valuations, I think, for the balance of the year.
Tim, are there any of these names where you've seen valuations fall, you think now might be the right time to move in if you believe things are going to start on the upswing the other direction here in the relative near term?
Well, I don't think interest rates are going lower anytime soon,
right.
And therefore I don't think tech multiples should be coming down or be more attractive, I should say. If anything, it makes them look that much more offsides. I think investors need to be very careful about tech companies that are telling you that we are a software or a recurring revenue story and we're not necessarily reliant on hardware. And there's a few companies like that. I mean, even Peloton. Those are the headlines I'm seeing in their release today. Apple's a story that we have re-rated the company. That P is double where it was 5 years ago, and it's because of services. Is it deserving of that? Well, I think Apple deserves as bulletproof of a multiple out there, at least in mega cap tech, because of their balance sheet and because of what they can do. But I think tech multiples are going to be under more pressure, and I think just in terms of allocation, I still believe that industrials and energy look pretty attractive here.
Karen, you were sort of nodding your head as Tim was talking, interest rates going higher, thus maybe tech doesn't make sense to jump into right now. Is that sort of what you were nodding your head in agreement for?
Yes, exactly. With the multiple, with interest rates being flat or higher, it's hard to see how there's a big improvement in multiples there. I'm short the IGV. I have been short that for a long time. It's sort of the high flyer software names, Intuit, ServiceNow, Adobe. I think Salesforce is the second biggest. Microsoft might be the first. But I just think that it's a good ballast against some of the, Google's my biggest position. I think of that as value tech, and I want to stay short this for as long as I think the Fed is in hawkish mode.
Guy, are you in agreement?
In terms of Google, absolutely. I mean, the move from 152 down to the low 100, stock that's trading slightly higher than a market. Actually, it probably is a market multiple, given the rally we've seen in the S&P, 19 times. So if you're looking for a place that makes sense, that I think still has a pretty wide and deep moat, it's Google. Some of those other names, it's hard to wrap your head around. Look, Snowflake's a great company, trading, Dan said, 30 times current revenue, probably 22 times next year. I mean, that's still pretty expensive by any valuation. So Google, if you're looking for a place where you can get a pretty significant value in a pretty, difficult environment, to me, it's Google.